Hello, mortgage fans. So we're back for another market update, and this week I have a guest. I have Mr. Mike Brooker with me. How are you, sir?
Very well, thanks. Very well.
Excellent. Today, Mike is going to talk through a case study specifically around bonus income. This is a very timely topic because particularly this time of year, a lot of people are getting bonuses. We work in the London market with a lot of higher earners, and on the face of it, you might think it's a very simple thing. If I've got my bonus and get a mortgage, actually, it's probably a bit more complicated than you might think about that. So Mike's going to sort of talk through a very specific case study, and then we're going to finish off with sort of the most commonly asked questions in this area as well. So if you do get a bonus and looking to get a mortgage, this is probably a good place for you to start. So without further ado, over to you, Mike. So you've been a broker a while, been with us, and also got a background. Do you want to talk through a bit about your background before we dive into the case study?
Yeah, sure. I've been in the financial services industry since probably 2000, 2001. I qualified as a mortgage advisor in 2007, through working for mostly through the banking sector, moved into broking with your good self in 2015, and been here ever since.
Right, is that what turned your hair grey? Working for me. Cool, very solid background there. And again, that leads us beautifully into the case study you want to talk about. So why don't you talk us through the client you helped, their situation, and what made it interesting?
Okay. What made it interesting was the makeup or the background of his bonuses. So he was in receipt of a quarterly bonus, which is fairly common, fairly straightforward in its own right. But part of his employment contract was that he would receive 50% of that in cash in the normal way that everybody does, but the remaining 50% would be issued to him in company stocks. So he was then obviously either allowed to sell those stocks or indeed hold on to them, whichever he saw fit. And because the 100% of the bonus appeared on his payslip every month or every quarter, he paid all the relative tax and national insurance, etc., so that when he cashes them in, all of that cash is his own. So what we were able to do is, because ever since he'd been working for the company, which was for a number of years, we were able to demonstrate to the lender that when he receives that bonus, he then cashes in that bonus straight away. So in other words, sells those shares straight away. And then the following month would then receive that cash into his bank account. So effectively, he was then transferring all of his bonus into cash. So the lender was then, based on us being able to demonstrate, one, that it was contractually obliged to get that stock income, but because we were then able to show them that he was effectively cashing them in every quarter, they treated the whole thing as cash bonuses, which was quite interesting.
Got you. And again, I think it's probably worth sort of dissecting that a little bit, because most people may not even be aware of sort of the complications around it. So, just with sort of bonuses as general, not all banks include all of it. Is it probably fair to say? I think the majority of banks only really include about half of your bonus.
Yeah.
And sometimes that's like a 2-year average as well. So that can have a very, very big impact on how much you can borrow. So if you get a £100,000 bonus, you think, well, I can probably borrow 5 times that. But then actually, if a bank only takes half of it, that's only half the amount. It has a huge, huge knock-on impact. So actually, I don't think many people are aware of that. So getting all of it included is really good. Secondly, the vesting stock thing, that's probably still quite niche, and we've seen it more and more. And funny if you mentioned that client in tech there, I've got a lot of my own clients in tech as well. We're seeing it more in that sector, but you can see it in banking and other areas as well. Just out of interest, we probably deal with 100 or so high street banks. How many of those do you think actually take vesting stock schedules or would accept it?
If you're talking, your traditional high street banks, very, very few. I would say, in total, there are probably only a matter of half a dozen or so that would even consider looking at a vesting share schedule or a vesting bonus schedule. Your go-tos for those kind of clients are, your private banks, some that understand vesting schedules, etc. It's very rare that you can get these on the high street, because they're only really interested in cash bonuses, and as you quite rightly say, the ones that we can demonstrate and then take the 50% or the 2-year average, or whatever their version of how they stress test bonuses is. So it's very unique to be able to get that on the high street.
Got you. And so, I mean, just to make it more specific then, so if they hadn't gone to you and just gone to, your bog standard Halifax, Nationwide, that sort of guy, so would they have even got close to the loan if they just used their bonus or maybe even the cash? Would they have got anywhere close to where they needed to get to?
No, in reality is no. I mean, I think this particular client wanted to borrow just over 300, and when we calculated it without using that income, it was closer to 200. Because the bonuses themselves were such the vast majority of his total income, because of the way they stress test, particularly for him, because if they only included the 50% of his bonus and they were only going to include 50% of his actual bonus, effectively they would have only been using 25% of the whole pot, because it would have been half of his half. So it knocked out a considerable amount of his bonus had they have just gone to standard high street or whatever. So it was quite a good news story for him.
No, I completely get it. I think that's again just the benefit of working with brokers, is that, as you mentioned, maybe half a dozen or so lenders that deal with this, but we know the right ones.
Yeah.
It's a classic, by knowing the right bank, or other way around. If you didn't go to the right bank, you'd only be able to borrow 2/3 of what you need.
Yeah.
And that doesn't really help when you're trying to buy a property, because one or two, and this is always my concern, is if someone goes to a bank and they say, well, you can't borrow X, you can only borrow Y. They might even go and buy a property that's under their budget, have to sort of make some sort of lifestyle sacrifices for something they can very easily afford. So it's not even pushing the boundaries on the affordability. It's just understanding the income, which is just so essential, really. So, and you mentioned that's a high street lender you went with. I mean, roughly what sort of the terms you secured for the client?
Pretty standard terms. I mean, the 2-year fixed the client applied for was, I think, 1.45, I think it was in the end. Standard 35-year mortgage. Everything else about the mortgage itself was very, very straightforward. It was just that the only real unique part of it was his income and the makeup of that income. But everything else was pretty much standard terms. So he didn't have to pay any extra for the bank being flexible or anything like that, which was, again, good news.
And again, many people misunderstand that. I mean, to this day, I still speak to clients where they say, oh, my situation is complicated, they're probably going to load the rate. It doesn't work like that. Either the bank accepts it or they don't. And if they accept it, you get the standard pricing. And you mentioned there, 1.45 for a complicated deal. That's really cheap. You don't have to sort of, this is the point I really want to stress, you don't have to go off piste, and because we say bespoke or specialist unit, whatever, you're not paying for that. It's, you don't have to pay over the odds. You can go private banking, but it's just more expensive. I mean, not horrifically, but it just keeping loans where we can on the high street just keeps the cost down. I think that's the skill of a broker, is just understanding, as you've done there, looking it through, placing it with the right bank, explaining the situation correctly as well. Because again, in my experience, many people sort of might even go to the right bank but not explain it correctly. And then how you present the case is just so fundamentally important. So I think that's an excellent case study, an excellent job for your client. No wonder you do well at this job, Mike. Very, very good. And that brings me very nicely on sort of the most commonly asked questions in this area. So we might sort of touch on some of this, but what we'll probably do is expand this out a little bit. So the number one question is, do bonuses count as income for a mortgage? I think we've covered that quite well. The answer is, it depends.
Yeah.
It very much depends on the bank. But I mean, if you just think through some of the sort of common things that you might see, so you obviously get like monthly, quarterly, annual bonuses. Just in general terms, how do you feel that most banks in generality sort of deal with that?
I think the vast majority of them will all pretty much do it the same way. So if it's like anything less than annually, there's always an average. So for example, if it's monthly commission or monthly bonuses, it's usually take the last three pay slips, take the average, times that by 12 and assume that as your kind of annual commission or annual bonus. And then there's a couple of sense checks underneath. They might ask for a P60, for example, to see if the numbers add up. So what did you earn last year to this year? Again, the common misconception is, well, I earned so much more this year, and how's that going to work? And again, it's just all about the averages. So from my perspective as a broker, it's trying to work out which lender is going to be the most generous. So is it the one that does the 6-month average, or the one that does the 3-month average and times it by 12, and all of those type of sort of intricacies, if you like, of how the lenders calculate the bonuses. And then, as we said earlier, that, you know, once you get up to your annual bonuses, it's all about the 2-year average. So the vast majority will do a 2-year average. There are one or two that will do, for example, 60% of the most recent. But again, that comes down to, okay, am I better using 60% of the most recent or 65% of the 2-year average? Which number is higher, and which lender do I go with to get you the most mortgage? So that's the trick of it. And as you say, the dark arts of brokering is knowing which lender is the right fit for the client for what they want to borrow. And if it's a case of, you know, here's the top 20 lenders, which one's going to lend me the most? Because of how often we do it, generally the first one we go to is the one we know that are going to lend them the most, because we've done the calculations in our head already.
And conversely, if you're not pushing the boundaries, it's relatively straightforward. But actually, I think it's often in house purchases where this comes up a lot.
Yeah.
Where someone's like, okay, and we're often asked the question, how much can I borrow? It's the two most frequent questions I've ever been asked as a broker is how much can I borrow and how much is it going to cost?
Yeah.
So, but again, if you're remortgaging, if you're not pushing the boundaries, it can be a bit easier. But you're absolutely right in what you say. And that brings on very nicely to the next question, which is how to calculate bonus income for a mortgage. So again, you talked in sort of general terms there, and I think probably to break it down to a few specifics, you sort of touched on quite a lot there already, but you know, what do most banks take into account? You know, obviously banks take a range, but would you say if someone wants to just apply my bonus is X, what should I be able to borrow that? What sort of a rough rule of thumb to give someone to take away?
I think if you use 50% of the average of the last 2 years, you'd be there or thereabouts with the vast majority. I think, you know, anything more than that would quite literally be a bonus, but that would be up to me to work out. But if
we did, that's nice.
But if you wanted to apply a general rule of thumb, average of the last 2 years would be where I would probably put the vast majority of lenders. As I say, there are quirks in there as well. For example, if the most recent bonus is lower, they might only use that one. So there's lots of different things in there, but as a general rule,
just a rough rule of thumb.
Yeah.
And then on the flip side, what's the maximum? What would you sort of say? So that's the rule. I say 50% of your last 2 years average. I think it's a fair starting point. If someone says, what's the most generous?
So the most generous, if you're talking just standard, you know, high street, pretty much there are more than one or two that do it. You know, 65% of the either the most recent or the 2-year average again. As I said earlier, there are one or two that might use a little bit more, but again, depends on the track record, what evidence we can provide and things like that. But if you're talking general rule of thumb, the maximum would probably hover around 60-65%, something like that.
I think that's fair as a general rule. I think, but if you're pushing the maximum, I know I've seen recently where you can get 100% of your last year's bonus.
Yeah.
Maybe not your bog standard high street guy,
Exactly.
But
yeah.
I think, that's where you do talk to someone. Maybe you would pay a little bit more on the rate for it, but probably 100% of the bonus can be included, but there's a little bit of a premium to pay on the rate. I think fair.
I think that's where you're getting into you're getting what you pay for at that point. Whereas, you know, if you keep it simple and keep it straightforward, you're going to keep on the high street, you're going to keep decent rates and things like that. And I think we said about it earlier about, you know, is that going to cost me more money because they're being more flexible? In that type of scenario, possibly yes. But
it's still a yes no with the lender, isn't it?
Exactly.
The product's not different. It's just that lender price is a bit more, but that'd be the reasons why a bank's a bit more expensive.
Yeah.
So, why are certain banks cheaper and more expensive? Well, if you're more expensive, they're a bit more liberal. So that's often the rule. And I mean, in my experience, please correct me if I'm wrong, but generally paying 0.5% to 0.75% more, you don't tend to be paying crazy amounts more.
Yeah.
You have to get into very specialist stuff to start paying 2-3% more.
Yeah, I think once it comes down to the sort of the finer details, it's pounds and pennies. You know, the difference in reality, but there's not a huge difference. You're not paying double or anything silly like that.
And the last question is, can you include vesting stock schedules, which I think we've covered off. So I don't think
Yeah.
we need to rehash that. But I think the only thing I'll probably expand out is, we've talked a lot about bonuses, which are quite commonly cash bonuses. In the more complex area, you do get vesting stock, you do get carry, there might be shares awarded, outside of vesting, that type of thing. So again, all of those things sort of count. But I think once the further you go away from a cash bonus, the more specialist it becomes, and that's where it might become more the preserve of a private bank. Is that probably a fair summary?
Yeah, definitely. I think once you're out of the realms of anything that's paid in cash, then yeah, you're very much getting into specialist lenders and as I say, like people like private banks, because private banks know how all that sort of stuff works. So they're well versed in dealing with it. So again, it's I suppose that the message to hit home really is, if you're paid a bonus of some description, there is someone who will lend to you based on that bonus. It's just down to us to find that lender as quickly as possible and on the best possible terms. So whether that be on the high street or whether that be in the private banking sector, there will be someone that will say yes. It's just whether the terms are acceptable or not.
What a beautiful summary, and what a lovely place to leave it, Mike. So again, I think you've summed up directly why it's worth talking to brokers, because we don't talk about one bank's products, we talk about all of them. And the classic thing is, as we've alluded to a lot through this conversation, is clients sit down, okay, what do you want to achieve? Well, let me worry about all these little technical things you mentioned, what percentage, what the average is. Like, just give us the information, let's deal with it, and we'll let you know the best we can do. So I think that's a very good way of ending it. So thank you very much for your time, Mike, and I look forward to catching up with you sometime soon.
See you soon.